If there's only one takeaway from this series, it's this: you probably need help. Ferris here. What if instead of being a pain in your side, accounting and finance become a story that helped you make decisions and achieve incredible goals? That's what we're discussing in the final part of this mini-series. So far, we've covered why you need an accounting professional, how they can help, and when to hire a CFO. Once you have your books in order, the accountant reconciles your books monthly, everything is categorized, and you know your historical data and month-over-month trends, you're in a good position to leverage this financial data to improve the business. Think of everything we've covered so far as looking in the rearview mirror, looking at what happened financially last month, last quarter, or last year. Now we want to focus on looking ahead and use the historical data and trends to inform business decisions. And this is the time to engage a full-time or a fractional CFO, depending on your needs, an experienced controller, or a director of finance. This role can chart your financial model, metrics, key performance indicators, KPIs, develop forecasts, educate on and implement compliance measures, create contingency plans, keep a close eye on cash flow, and most importantly, inform your growth strategies. I remember in my first startup, when we had VC funding, we hired a CFO right away. In a later startup, money was tight and we waited before hiring a CFO, another regret. But both of these CFOs in both ventures were brilliant and helped me and the management team look at our numbers in ways I could never imagine on my own. Here are some ways these professionals can help you with your financial savviness. But please note that each business type is likely to have unique KPIs and different approaches to finance. In my services startup, we first developed a simple financial model using Excel, with a column for each month of the year and rows for the various categories of revenues and expenses. We forecasted revenue, estimated expenses, with the focus on meeting our profit margin targets. Then, on the 5th business day of the month, the CFO would take the accountant's data, enter it into the model, and start an analysis. For example, we systematically looked at planned versus actual for revenue, expenses, and profit margins. If revenue was off, we'd dig deeper. Did we not close the opportunities in the sales pipeline? Did we lose revenue from an existing customer? When you dig, you understand what actually happened. And then you take this data to your sales and delivery teams and address the issue that led to those missed targets. Our CFO helped me understand the concept of revenue recognition, a principle in accrual accounting indicating when you count your revenue as we move from cash basis to accrual basis. It took me a while to get and implement revenue recognition in the business, but that turned out to be super critical when it came to reporting on our EBITDA and company valuation during our acquisition and working with the buyer. The CFO helped with planning too. Gradually and organically, as our business model evolved to include different business lines, so did our financial plan. We started to bake in more accurate lead times for revenue. More accurate revenue projections enable us to do a better job in forecasting labor requirements. Also, and depending on your business model, you may want to build in an estimated retention or estimated churn. That will make sure your revenue and profit projections are more accurate. Speaking of projections, as you grow, cash flow is critical. It is the lifeline of the business. One of the very first things that the CFO identified was cash flow management and specific actions to improve it. We established a more efficient process to review and act on late customer payments. We asked our sales teams to negotiate better payment terms, like asking for net 15 instead of net 30 or net 60. That is, customers to pay within 15 days of being invoiced net 15 instead of giving them 30 or 60 days, allowing us to receive cash sooner. We took the opposite strategy with vendors, asking the purchaser to negotiate better terms on when to pay our bills. Every little bit helps, especially in the early phases of your startup. As Sir Richard Branson once said, I'm paraphrasing here, delay paying your vendors as much as you can, but always pay your bills. I didn't delay because I was cheap, we did this to survive. When our margin and cash flow improved, I made sure we paid everyone on time and even sent gifts to our vendors. A CFO can help with hiring team members in different geographies with varying labor costs. A location and/or staff in Silicon Valley will have much higher costs than in West Virginia. A good financial model will incorporate the respective costs and contribution to revenue for each location. This will inform future hire decisions. These decisions affected profit margins. Having more clarity and certainty about profit margins allowed us to plan increases to our team members, to their benefits, in addition to quarterly and year-end bonuses, as well as charitable donations. We were always transparent with our team, and the better reporting helped us share more with the team members and created a high sense of ownership and trust. I loved it. As we got more savvy, our CFO introduced more elaborate and more advanced financial analyses to help with part of the business we were guessing about. For example, which client types by vertical or by potential revenue were most worth our focus. You can take it further and develop a process to categorize your clients by profitability, not just by revenue. Identifying your most profitable clients will serve as sales gems and actionable insights to attract and retain the type of clients that will fuel your growth. Such processes sound easy, but it requires sophistication, blending your operations data from sales, delivery, and customer support into your financial data, but it's worth the effort. You can't get high visibility and actionability in the business without it. That's a lot, isn't it? But hopefully you've seen the light. CFOs and controllers aren't just expensive bookkeepers, they are so much more. They are your financial fortune tellers, pun intended, helping you make fast, accurate, and reduced stress decisions. Should you hire that executive who just left your competition? Can you afford to acquire that small startup? What happens if you fire that pain-in-the-neck client? A professional can give you the data, track goals, and help you achieve much more. If there's only one takeaway from this series, it's this: you probably need help. Accounting professionals aren't just another cost or expense. They're an investment in the health of your business as well as your own peace of mind. Now it's time to give back. Share with these professionals you're hiring how you're helping others, and then gently encourage them to share their financial expertise with a charity that they believe in. Charitable organizations are in dire need for financial expertise, especially CFO level. If they're not already involved, suggest your professionals donate some time. And if you're enjoying these tips on accounting best practices in our video series on how to grow your business, don't forget to hit the like button and subscribe to this channel. I'd love to hear from you. Leave me a question or a comment on how you leverage financial data to grow your business.